Okay, let's dive right into this explainer and unpack the unseen mechanics of how companies truly operate and, honestly, how they survive. Today, we're looking at a fundamental concept that literally makes or breaks companies every single day, yet it's often entirely misunderstood by pretty much anyone outside the finance department. We're talking about cash flow, and more specifically, the absolute necessity of business financing. Most people just assume that if a business sells a great product and makes a solid profit, it succeeds. Easy, right? But as we'll see today, the reality of running a business is way more complicated than that, and it all boils down to one crucial thing: timing.
To really wrap our heads around this, I want you to put yourself in the shoes of an entrepreneur for a second. Imagine you own a small custom furniture business. One morning, your phone rings, and it's a massive hotel chain. They want to buy 500 custom chairs from you. It is, without a doubt, the biggest order you have ever received. You're absolutely thrilled. You're celebrating, right up until you sit down and actually do the math. Because fulfilling this massive order requires serious capital, right now. The wood alone, that's going to cost you 40 grand. The labor to actually build the chairs, another 20 grand. And shipping all of that to the hotel adds another 10 grand on top of that. Before you can even think about delivering the product, you have to front $70,000 in immediate out-of-pocket expenses. And here is where the harsh reality of business really sets in. To make matters even more stressful, the customer isn't going to just hand you a check the moment you drop off those 500 chairs. Day 0, sure, you've completed the delivery. But then, you're just waiting. Day 15 rolls around. Nothing. Day 30. Day 45. Still waiting. The standard contract usually dictates that they won't pay you until 60 days after delivery. That is 2 agonizing months where you are out 70 grand, hoping nothing goes wrong, and just praying you can somehow keep your own lights on in the meantime. So, that brings us to this crazy paradox. You can actually have a highly profitable business that still completely fails, simply because it runs out of cash before payday. On paper, you'll look great. You have the massive hotel order, you've got eager customers, and you've got fantastic margins built into the price of those chairs. You're running a thriving company, but your cash flow reality is a completely different story. You have zero money today to actually pay your suppliers and your workers. Congratulations, you've just discovered one of the biggest, most lethal traps in business. Everyone thinks businesses fail because they don't make enough money, but in reality, some wildly profitable businesses collapse just because they run out of cash before they ever see a dime of that profit. And look, this is exactly where business financing comes in, but we really need to reframe how we think about this. Financing isn't free money, and it's not just about taking on some burdensome debt. It is, quite literally, borrowed time. Think of it like building a financial bridge. Your business is standing on one side of a massive cliff with today's immediate expenses, and your payday, tomorrow's income, is way over on the other side. Without building a bridge to connect the two, your business just falls right into the cash gap.
Moving on to Section 2, Choosing Your Financial Tools, Building the Right Bridge. Because there are a ton of different types of financing out there, and each one acts as a very specific tool for a very specific problem.
The most common tool you'll hear about is, of course, the classic traditional business loan. It's a super straightforward mechanism. Let's say you need capital, so you go borrow $100,000 from a bank. You get that massive lump sum up front, which lets you build your bridge. But the trade-off? You agree to pay it back over, say, 5 years, along with a little extra in interest. The bank makes its profit from that interest, and you get the cash you desperately need right now. It's just a simple trade, getting the money you need today in exchange for paying a bit more later. Now, what's really fascinating is how invoice financing solves a completely different kind of headache. Sometimes you don't need a massive 5-year loan. You literally just need to survive until Friday. Imagine you just finished a huge $200,000 project. Step 1, you send the invoice, but the customer says, "Great, we'll pay you in 90 days. The absolute nightmare here is that your employees expect their paychecks this week. So, step 2, instead of waiting 3 long months, a financing company advances you most of that 200 grand right away. Boom, you pay your staff. Step 3, 90 days later, the customer finally pays the invoice directly to that financing company. And then step 4, the financing company keeps a small fee for their trouble and sends you the remaining balance. Yes, you gave up a tiny percentage of your profit, but you bought yourself time. You kept the whole shebang running smoothly.
But hey, what if your cash flow is just kind of unpredictable? If you only need a safety net, a line of credit is an absolutely incredible tool. See, with a traditional loan, you're forced to borrow this massive lump sum all at once, and you're paying interest on the whole thing, whether you use it all or not. But a line of credit, it acts way more like a business credit card.
You get an approved spending limit, let's say 100 grand. The beauty of this is that you only pay interest on what you actually use. If you just dip in and grab $20,000 for a quick expense, you only pay interest on that 20 grand. And once you pay it back, that full $100,000 limit is instantly available to you again. It gives you immediate access to funds without completely overcommitting yourself.
Then, of course, there are those situations that require massive physical purchases. Think about a construction company that desperately needs a brand new $500,000 excavator to take on bigger jobs. I mean, buying that machine outright in cash? That would instantly wipe out nearly all of their cash reserves and put the entire company at serious risk. Instead, they use equipment financing, which lets them pay off the machinery over several years. The brilliant part about this strategy is that the excavator is out there helping generate new income while it's simultaneously being paid off. So, in essence, by spreading out the cost, the equipment literally pays for itself over time.
And that brings us to what's known as trade finance, which perfectly encapsulates this classic standoff. The supplier wants their payment before they ship, but the retailer wants to pay after they actually receive the goods. Imagine a clothing retailer ordering massive shipments from a supplier halfway across the world. Neither side fully trusts the other, right? The supplier isn't putting goods on a boat without seeing cash first, and the retailer sure isn't sending cash without seeing the goods. Trade finance is when a financial institution steps right into the middle of this standoff to guarantee the transaction. They essentially build a bridge of trust. And because of that guarantee, everyone gets what they need, and global business just keeps on flowing.
So, looking at all these tools and the interest fees involved, you might be asking yourself a very logical question right about now. Why don't successful companies just hoard their cash, build up a massive savings account, and avoid the cost of financing entirely? I mean, why pay a bank if you don't absolutely have to?
Well, the answer to that is really fundamental to how business works. Money sitting stagnant in a bank account isn't doing anything to grow the business. Businesses exist to create value, and creating value requires active cash. It means investing in new inventory to meet customer demand. It means hiring top-tier employees before your competitors snatch them up, buying essential equipment, opening new physical locations, or launching the next innovative product. Every single dollar tied up in a static savings account is one less dollar doing those crucial tasks. Financing essentially gives businesses the leverage to move faster and capture way more market share than their cash savings alone would ever allow.
However, and this is a big however, let's be very clear. Financing isn't magic, it's a tool. And just like any tool, it can be incredibly dangerous if you use it wrong. Take the desperate borrower. This is the company that borrows way too much, takes on ridiculously expensive loans, and suddenly finds that all of their hard-earned profit is vanishing completely into interest payments. If you ignore your cash flow realities, even a successful business can be crushed by debt. But on the flip side, we have the smart borrower. The smartest businesses out there don't borrow out of panic. They borrow because they have a precise, calculated plan. They know exactly how the cash they are borrowing today is going to generate even more cash for them tomorrow.
Ultimately, when you step back and look at the big picture here, business financing really isn't about taking on debt. It's about timing. It's about making absolutely sure that incredible opportunities, like that 500-chair hotel order we talked about, aren't lost simply because your cash happens to arrive a little later than your expenses do. It all boils down to this. Profit is important for sure, but cash flow, that is what keeps the lights on. You could have the greatest product in the world, but if your timing is off, the game's over.
So I'll leave you with this final provocative thought to chew on. Whether you're running a business right now or maybe planning to in the future, are you losing opportunities to grow simply because you don't have the right money at the exact right time? The difference between success and failure isn't always about finding more customers or, increasing your margins. A lot of the time, it's just about having access to the capital you need exactly when you need it. Understand your cash flow bridge, master these financial tools, and you won't just survive that perilous gap between expenses and income, you will absolutely grow across it. Thanks so much for joining me on this explainer, and keep building those bridges.